Hello, everyone. Thank you for joining today's National Landscape of Pass-Through Entity Taxes webinar. Today's program will be presented by Jonathan Weinberg, Jason Rosenberg, and Dowdy Tang. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a question box. All questions pertaining to the webinar content will be answered at the end. We will do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Jonathan, Jason, and Dowdy.
Thank you. So today we'll be talking about the pass-through entity taxes for various states, not to be confused with withholding tax that's imposed on pass-through entities. With the passing of TCJA, there is a $10,000 SALT cap for individuals under federal income tax. So what states started doing, especially those with high income tax rates, is they started looking for a way around it. So that's basically led to them passing this pass-through entity tax, which we'll be going through today, that kind of goes around that SALT cap limitation. Now, kind of want to just introduce the speaker we have with us. We have Jason Rosenberg.
Thanks, Dowdy. I'm a senior manager and team leader of the Withland SALT Income Service Line. Based in the New York region, I have over 12 years of experience in multi-state income tax, which includes state planning, nexus analysis, revenue sourcing, audit defense. It's nice to have everybody here. We have a lot to address today. So with that, Jonathan, you want to introduce yourself as well?
Yep, Jonathan Weinberg, Senior Manager in State and Local Tax. I've been doing state and local for 20 years. Again, predominantly on the income franchise side. We'll kick it off from there and not spend too much time on the intros.
Right, and I'm Dowdy Tang. I'm a state and local manager there, and I'll be moderating the presentation today. So just give an overview of the table of content we'll be going through. It will be the national landscape, kind of an overview of the pass-through entity tax itself. We'll be talking about the features of pass-through entity tax in general, and then we'll be doing a dive on the details of specific state PTE taxes, and then we'll kind of have a discussion, an open table to discuss kind of the different features of different states as well, and then follow up by questions. So if anybody has any questions at any time, feel free to enter them into chat and we will respond to them as we go through the presentation. So with that, we'll kick it off with Jason.
Great, thanks, Dowdy. So what we're seeing right now is a monumental change in state tax. The speed of change is unlike what we see in state tax historically, as states have been rapidly enacting PTE taxes across the nation. As we take a step back, right, historically, many businesses, such as family-owned businesses and larger joint ventures, typically arrange their affairs using a pass-through entity structure, such as a partnership or an LLC or an S corporation. And one of the centerpiece provisions of the TCJA, right, or what often we refer to as Trump tax law, which was passed in December 2017, was the $10,000 limitation imposed on the deductibility of SALT. So with the SALT limitation that has been placed at the federal level, states, right after the TCJA was enacted, started exploring SALT workarounds, as the SALT limitation profoundly impacted many businesses in their respective states. So the states started to respond by devising legislation to overcome the SALT limitation by passing various SALT workarounds. Some of the earlier SALT workarounds we've seen to date included the travel deduction, the payroll tax expense, and then later with the pass-through entity tax, the PTE, which we're going to be discussing today. Many of the earlier SALT workarounds had their shortcomings, but states started to find more success and traction with PTEs across the business community and with regulators. So what happened was, by the summer 2020, there were only a handful of states that enacted these PTE taxes. And then in November 2020, 6 days after the presidential election, the IRS issued Notice 2020-75, explained that they intend to issue proposed regulations supporting the use of PTE SALT workarounds. This taxpayer-friendly development would signal to the states that individual owners or shareholders of a pass-through entity would no longer be limited in the amount of state and local tax that can be deducted. So after the November IRS guidance that came out, what we saw was a significant acceleration in states either enacting PTE taxes or at least considering it with proposed legislation. And as of today, I'm going to guess there's probably about 20 or so states that have enacted a PTE tax. So it's important to highlight that the IRS did issue their guidance 6 days after the presidential election, informing that they plan to issue regulations, which kind of gives the appearance that this was rushed out the door, considering at the time it was likely seen that a new administration would be taking over the reins. So it still remains unclear if the Biden administration might administratively or legislatively pull the rug out on SALT workarounds. But it does seem less likely, as each day a new state enacts their own iteration of the PTE workaround. Pulling back the IRS guidance would seem politically less likely, but it is an area that still needs to be monitored. As you can see right on the slide, some of the earlier adopters, which helped transcend this new area of state tax, right, includes Connecticut, which was the first state to enact a workaround. Connecticut is a mandatory PTE tax, and New Jersey was also one of the earlier adopters, which we'll take a look at in more detail later today, as a lot of states do use New Jersey to base their workaround after. So with that, let's go to the next slide. So there's one common denominator of the PTE tax, and that is to produce a SALT deduction at the federal level, right? So the objective is quite simple on the surface. Simply by imposing the tax at the entity level, the flow-through entity is able to deduct on its federal partnership return or S corporation return state tax expense, thereby reducing federal taxable income and therefore federal tax. So for example, the SALT deduction would simply reduce ordinary income on Schedule K1. Since the pass-through entity is responsible for the tax as part of making an election, the entity would be allowed a full deduction for state and local tax, opposed to individual partners who would be capped at the SALT deduction, right? So then the state would typically require an add back for the deducted state tax. So in essence, the state is still collecting the same revenue, but at the federal level, this in turn keeps the federal deduction, that subsidy, in place that existed pre-TCJA. So in essence, the states have found a clever solution to still provide business owners with a SALT deduction at the federal level while still collecting the same, state tax revenue. So with that, let's go to the polling question number 1.
And here's the first polling question. We'll give it a few more seconds as the polls are still coming in. All right, gonna go ahead and close this poll.
Perfect. Seems like overwhelmingly a number of our audience have heard of the PTET, but for those that haven't, we will be going in detail for it, so that's perfect.
Great. So, all right, perfect. So the next several slides, we're going to take a look at how rapidly these PTEs have really been enacted. The speed of this trend is unprecedented of any trend we've seen in state and local tax. Some of the more recent trends in SALT that we've seen is the adoption of single sales factor or transition to market-based sourcing, which has taken over a decade to transition and adopt for many states, with still many states still in the process of exploring such legislation. Legislation in state and local tax can often take years of analysis, and considering how many states are politically divided at the state legislative level, it's truly amazing how many states have enacted thus far. So before the SALT limitation in 2018, right, there maybe was a few states at best that had a pass-through entity tax on an income basis. And these were mandatory, non-elective taxes. Here we can see as the summer of 2020, at best, there were maybe 6 or 7 states with a PTE tax. If we look at the next slide, then we can see some months after the IRS issued, notice 2020-75, states in the Southeast, such as Alabama and Arkansas, enacted PTE taxes, as well as a number of other states across the US started proposing these taxes. We can see in the next slide in June that more states joined the club, with it spreading from east to west, with Idaho being the most western state at that point enacting a PTE tax. And then we can see in the next slide here, as a more recent, right, there's about 20 states now with a PTE tax. And you can see from east to west, right, states across the board have now enacted these taxes. And there's many more states that are considering these taxes that, probably will trickle throughout the rest of the year. It wouldn't surprise us if we saw maybe 30 states by the end of the year with a PTE tax, which again is really unprecedented for that kind of speed for these PTE taxes, for any type of development, state and local tax. So with that, if we go to the next slide. So the takeaway from any PTE tax is that the primary benefit is to sidestep the SALT limitation for business owners. In states where the PTE is based only on state source income, businesses that are most likely going to benefit are going to be businesses with significant state presence. However, states with PTEs that calculate tax on 100% of all resident income could see a larger benefit in states with resident partners, something that we see in New York for partnership entities, which we'll take a look at in just a bit. And that contrasts with how New Jersey BAIT, for example, calculates their PTE tax. If we look at the next slide here. So in terms of risks, there's plenty number of risks, right? Here's a snapshot of some of the primary risks that are generally associated with a PTE election. First, as we know, the IRS seemingly blessed the SALT workaround when they issued the notice in November 2020, saying that they'll be releasing regulations in the future that affirm the use of an elective PTE tax at the state level, which therefore will be deductible for federal purposes. However, as we mentioned, keep in mind this notice was published 6 days after the presidential election, so it gives the appearance that the Trump administration may have, had the IRS expedite the release of this guidance. And so with the new president who took oath in January, it's still to be seen if the Biden administration may attempt to pull the notice. Again, it seems unlikely, but in the remote chance that it does happen, these PTE taxes across the United States will go into limbo and potentially create a lot of havoc. So unlikely, but it is still out there as a possibility. Second, the biggest concern that needs to be front and center with any of these states with a PTE tax, the potential risk to the loss of an individual resident credit. So for example, here's the concern, right? If you have a PTE that's elected in New York, let's say, and let's say the business is a partnership with 10 partners. 8 of the partners are New York residents, but one of the partners is a New Jersey resident, and one of the last partner is a Pennsylvania resident. Normally, without the PTE election, right, the home states for New Jersey and Pennsylvania would provide a resident credit on their personal tax return to offset any double state taxation for the partner when it files its New York non-resident return. However, now with the election, the entity is paying the tax, no longer the individual. So the question becomes, since the individual partner won't be directly paying the tax at the personal level, would the partners of the home states of New Jersey and Pennsylvania provide a resident credit as the tax was paid out at the entity level? This is a very real issue. And while some states provide broader, more generous resident credits, other states provide a narrow view. And so while whatever benefit at the federal level for the SALT deduction needs to be considered, right, the consideration, the potential loss of resident credits also needs to be taken into account to see if those losses might outweigh any benefit. So the bottom line is modeling and analysis needs to include specific state review, taking into account state residency of the partners. State residency, the geographic consideration of those partners are going to be super, super important when making a determination if you want to make an election into the PTE. That being said, an equally important consideration, as you can see here, is that the PTE is computed to the extent there's source income in the state. So that's got to be a consideration when making, the decision to elect. As each state PTE uses a different mechanism to compute state source income, the lack of presence in the state, such as customers in the state or any source sales, derived from the lack of physical presence, such as employees in the state, might result in a lesser benefit. So again, modeling is super important to determine the level of state sourced income when making a determination for election. Another area that needs to be mentioned is cash flow, right? Some states would have duplicate estimated payment requirements, where that an estimated payment might be required at the entity level, in addition to the normal withholding requirements on non-residents at the partnership level. So there could be two payments that are required, and then the the withholding, right? There would be a refund when the return is actually filed. So, it's a cash flow timing difference, but it's something that a lot of our clients we talk to on a frequent basis. We remind them of this duplicated payment concern that does come up quite a bit. And lastly, we've seen a lot of questions with investment partnerships where entities just hold investment assets if they would qualify if they elect in. While at the state level, they may certainly qualify if they're sourced income and might be eligible for the election. What is less clear is if the IRS will allow the deduction. Because think of this, right? When you're paying tax on portfolio income, right, there very well may be a deduction, but it depends on classification. And as the draft Treasury regulations haven't been issued yet, there's no guidance to date by the IRS with investment partnerships. So this area is a big, big unknown. If we look at the next slide real quickly, you can see how big of a benefit this can be. Really quick example, right? You have a partnership here with $5 million taxable income where partner A is a resident of state A and partner B is a non-resident. And you can see based on how this example and how state A may tax this partner, we're looking at a benefit, an effective tax benefit of $108,000. So again, every state has different rules, different ways of calculating state source income, but this is just an example to show you using actual data, using actual numbers, I should say, what the benefit might look like. So with that, I'm going to turn it over to Jonathan to talk a little bit more now about some of the features we need to be thinking about with a PTE tax.
Thanks, Jason. So moving on to the first slide, there's really four main considerations that any individual or any partnership pass-through needs to take into account in determining whether to make the election. So the first one is, well, what is the election process? And is it mandatory? Is it elective? Is that election revocable if it turns out to be not beneficial? The second one is the entity eligible to make the PTE election, where you have to look at the composition of the members and see if everyone is eligible to join a PTE election. Does the presence of owners who are in turn partnerships or other pass-throughs make the entity ineligible to elect PTE taxes? The third is, what is the state tax base? How is the tax going to be computed at the PTE level as opposed to each individual picking up the income? And then finally, how is the state going to make the owners whole for the PTE tax paid, at least in that state? Are they going to either exclude the income from the computation of that individual's state source income, or are they going to provide a credit for the PTE paid? So moving on to the next slide. So the first one is, what is the election process? Is the election mandatory or is it elective? Right now, there's only one state that it appears where the PTE regime is mandatory, and that is Connecticut. In the remaining states so far, they tend to be elective. Second one is, if it is elective, is it revocable? Many states are saying that once the election is made for that year, that you are stuck with it, that you may not revoke the election. So if you're going to make that election, you need to be really sure that it's beneficial and that there's no adverse effects in other states. Next question is, can the entity make a retroactive election? If you miss a deadline, will the state give you forbearance essentially and say, well, we'll let you make a late election or not? So far, very few states seem to be doing that, but again, these are all moving targets. Next one is, does the election need to be made on an annual basis? In some states, once you elect into PTE, you might continue that election unless it's affirmatively revoked. Next question is, in the first year of election, are there different due dates than in subsequent years? A perfect example of that is in New York. The date for electing PTE for the first year is October 15th, but in every subsequent year, the date for electing PTE is March 15th. So again, there are different requirements depending on the implementation and the tax year involved. There's a question is, who's authorized to make the election? You wouldn't want to have a state come back and say, well, the person who signed the form is ineligible and therefore your election is ineffective. You need to look into those details. Next question is, will all the members benefit from electing the pass-through entity tax? Jason already touched on the fact that some states will deny a credit for pass-through entity taxes paid to other states. An example of that being Pennsylvania will likely deny a credit for taxes paid to other states under a PTE regime for owners of a partnership. Well, if you have one owner who's a 51% owner and they're only going to benefit, and the 49% owner is a Pennsylvania resident, what do the partners there do? I mean, the owner who owns 51% can certainly make the decision, but they're going to have to live with a very unhappy 49% partner if they do that. So that's certainly something to be taken into account. And then finally, how are tax exempt and foreign members treated? Again, are they eligible? Do they prevent an entity from being eligible to make a PT election and so forth? Moving on to the next slide. So eligibility. So again, what is the first year a PT election can be made? So that all of these taxes are new. They generally did not exist before this past year. So again, what is the first year that you can make a PT election? Is it 2020, 2021, or 2022? So that's certainly a consideration. The next is what entities are eligible to make a PTE election? Is a PTE, in some states, a PTE election might only be eligible for partnerships and LLCs and not S-Corps. In other states, S-Corps are also eligible to make a PTE election. Who are the eligible PTE owners? So which partners and shareholders can be included as part of the PTE? And again, this also affects eligibility. We're going to talk about in a little bit in California. If you have a tiered partnership structure where you have partners who are in turn partnerships, that makes the partnership ineligible to make a PTE election. Whereas having a corporate owner, you may still make a PTE election, but the owner won't be able to take part in the PTE tax. And then finally is, does the PTE require state source income? So again, looking at how the apportionment runs, do you need to affirmatively show that you have state source income to be able to make that PT election? So moving on to the next slide. So again, state tax base. So again, the state tax base for the purpose of computing the PTE tax may be different than the tax base for the individual owners. So there certainly can be entity type considerations where you have to look at resident owners versus non-resident owners differently. In many states, resident owners do not take apportionment into the account when they determine their portion of the PTE tax, whereas non-resident owners compute their tax on an apportion base. Again, how is a tax base calculated? Do you have to add back guaranteed payments to partners? In states where you have an S-Corp that makes a PT election, do you have to add back W-2 compensation potentially to S-Corp shareholders? What other state modifications need to get included in that base? And how do those computations differ from what the individual income tax base would be? Again, does the PTE allow for an alternative tax base? Again, there are certainly situations where the computation of the PTE can wind up with owners being significantly over withheld compared to what their individual liability would be. So is there an available alternative base to get a better match between what an individual's liability is compared to what the PTE tax base is? Finally, looking at, well, what are the sourcing rules? The sourcing rules for the PTE might be different than for a partnership or an S-Corp return. For example, in New Jersey, Jason will touch on this in a minute, that S corps still use partnership apportionment for computing the PTE tax, which is very different than the apportionment methodology used by an S corp. And then finally, how do you treat an NOL for a pass-through entity? Generally, pass-through entities don't have a concept of an NOL because all the attributes are really owned by the owners or taken into account on the owner's tax return. Well, now, if you're going to levy a tax on a pass-through entity directly, and that entity generates a loss, wouldn't that entity have to also get the benefit of that loss at the entity level? Moving on to the next slide. So again, the primary feature is looking at the owner income offset. And this is of critical importance. So some states, the owner gets, they get their share of the tax paid at the entity level, and they take that as a direct income tax credit on their own personal income tax return. So they get a dollar for dollar reduction for whatever was paid at the PTE level. They get that on their personal return. Now, not every state gives 100% credit. Some states limit the credit to 80 or 90% of what was paid at the PTE level. So in essence, the state is skimming the preservation of the federal deduction on SALT taxes. There also might be provisions whereby if you're overpaid, you don't get a refund. You might only get a credit carryover. But if the way the PTE works means that you're going to be overpaid every year, year over year, you may never get the benefit of that credit carry forward. On the flip side, some states, instead of giving a dollar for dollar credit for the PTE paid, what they do is they create a subtraction for the income that was subject to the PTE tax. So the individual would take a subtraction modification in determining their state income and reduce their taxable income by what was already subject to the PTE regime. Moving on to the next slide. I guess that brings us.
And here's our second polling question. We'll give it a few more seconds as the polls are still coming in. All right, gonna go ahead and close the poll.
All right, perfect. So even the states that are currently false with the speed of adoption for these different states, very likely they can become true in the near future. Before we go on to the next section, just have a quick question, Jonathan, if you don't mind. Seeing coming in chat, great questions coming in. It's regarding kind of the electability and the irrevocable portion of the election. Are those determined annually, or is that a one-time determination?
And the answer is it really depends on the state. So for instance, New York, once the election is made, that election is irrevocable. But the election needs to be made on the date of the first installment payment is due for a calendar year taxpayer. So you need to make the election, say for 2022, tax year 2022, your election needs to be made on March 15th of 2022. And once you make that election, it's irrevocable. Well, that really puts taxpayers in a position where they have to count their chickens before they hatch. And so you can easily have a situation where a decision is made and then maybe there's a loss. Maybe there's certainly not enough income or nearly as much income as what was anticipated. And making the election wasn't necessarily so worthwhile. You can also have a situation where, owners look at the PTE tax and they say, well, this isn't really that worthwhile, so we're not going to do it. But then it turns out to be a transaction year. And while the New York apportionment might be very low, 1% of a big number can still be a very big number. And it turns out, had they made the PT election timely, it would have been worthwhile. So again, these are all considerations that need to go in and need to be done on a state-by-state basis every single year.
Perfect, thank you. I think we're going to move on to the specific state discussion with New Jersey bait up first.
Great, thanks, Saudi. And if we go to the next slide here, and to Jonathan's point, right, every state, right, there's no uniform single rule, or a single model for that matter. Although there's a lot of commonality between different states, there's also a lot of distinct differences. And so, it makes it very important to do a state-by-state analysis for the states that might be relevant for your business, because there are going to be differences between the states. And what might make sense for one business might not make sense for the next business in certain states and so on. With New Jersey, we're going to look at a couple of states, a few states here, a little bit more in depth as we go forward. And, with New Jersey bait, as I mentioned earlier, it was one of the earlier states post TCJA that adopted their own PTE tax. As a result, it did not have a lot of states to model its legislation after. And what we found that New Jersey in some ways is lacking its ability to make a clean election. There's a lot of different issues that come up with New Jersey, things that still need to be probably legislatively fixed, and hopefully will be done within the next year or so. But other states that later adopted PTE taxes like New York, we find a little bit cleaner in the way they enacted the legislation, which they had New Jersey and other states to model after, being able to kind of take advantage of knowing what kind of issues to work and resolve before they enacted that legislation. With New Jersey, right, in order to be eligible and make the election, you have to have at least one partner, member, owner subject to New Jersey's Gross Income Tax Act on its distributed proceeds in order to make the election to be taxed at the entity level. Unlike Connecticut, this tax is elective. And unlike New York, New Jersey requires state source income to derive any benefit from this election. Where in New York, which Jonathan will talk about in just a few minutes, right, resident partners will always benefit from the election, where in New Jersey, that is not the case. You still have to have sourced income to have any benefit from the New Jersey bait, as what they call it. Also, single member LLCs cannot make the election. So if you have a Schedule C taxpayer, there might be some planning consideration to take into account with a disregarded entity who might benefit from the SALT workaround by possibly adding an owner such as a spouse or another owner member in order to take advantage of the bait. And lastly, the annual election must be made on or before the original due date, which is March 15th. So New Jersey, one of the benefits to New Jersey, unlike New York, where that you have to make the election in New York by March 15th of the current calendar year, which you might not know if you want to make the election 3 months into the year, where New Jersey, you make the election the following year, the due date of the tax return. So you can make a little bit more of a analysis if you make sense to elect at that point or not. You'll have more information, more insight to be able to do that. So New Jersey does have an advantage when it comes to making the due date with the timing of it. If we look at the next slide here, it's important to note that the election needs to be, as we mentioned, by the original due date, right? But the state isn't allowing any special procedures or safe harbor if that date is missed. So that date has to be, relied on. Otherwise, there's going to be no retroactive election. And it's equally important to note that a bait election cannot be revoked after the due date. So once it's elected, there is going to be no revocation. If we look at the next slide here, in terms of the bait tax base, right, how you calculate the tax, this is going to be similar to computing state source income for withholding purposes, in that distributed proceeds are going to include net income, dividends, royalties, interest, rents, guarantee payments, and gains. New Jersey, under New Jersey bait, distributed proceeds are generally defined to comprise of most revenue streams upon New Jersey sources. An important note, though, to make is that New Jersey's Division of Taxation is interpreting that distributed proceeds for purposes of the BATE tax should be based on federal ordinary income opposed to using New Jersey state modified income. So in effect, not taking into account any state modifications like depreciation, state income tax, and so on. However, based on the legislative intent, it would appear that taxable income of BATE should mirror the calculation and computing partnership taxable income. However, based on how the legislation was enacted, New Jersey is interpreting that the tax base would lead to a similar definition of ordinary income for federal purposes. So for some taxpayers, this might be helpful, right, depending on their facts and circumstances, but other taxpayers, this might result in a lesser BATE tax. So it's something to keep in mind when you're modeling out New Jersey BATE savings, how they are tracking federal or how they're tracking ordinary income to be on a federal basis opposed to a typical New Jersey basis. If we look at the next slide, so after the BATE is computed at the entity level, right, there's going to be a pass through to each partner or shareholder of a BATE credit to be used on their respective returns. And while a non-corporate member, such as let me rephrase, such as an individual partner, will receive a BATE credit that's refundable, which excess credit is going to be treated as an overpayment. Any corporate member will be limited in the amount of BATE credit it can use at its entity level. It will have a carry forward of 20 years. So a corporate partner gets 20-year carry forward. A non-corporate partner, like an individual, will have a refundable credit. So one of the big issues here is that a member that's an S-corp partner, New Jersey Division of Taxation interprets that an S-corp, right, is subject to CBT rules, corporate business tax rules, and as such, an S-corp doesn't naturally generate any entity level tax, so it would not be able to use or refund any of its share of BATE credit that it receives from a pass-through entity that makes that election, therefore effectively trapping the use of a BATE credit to an S-corp partner, resulting in the loss of the credit. So as such, again, it's going to be super important with any tiered entity with an S-corp partner for New Jersey purposes that this is reviewed very closely, because a trapped credit potentially could outweigh any benefits. So we've worked with a lot of clients to help try and mitigate some of those kind of issues or concerns that we're seeing with New Jersey BATE. If we look at the next slide, so here we can see that the tax rate maxes out 10.9%, which is generally in line with New Jersey personal income tax rates. What's important to note, though, is that with a tiered partnership, it will require that each entity make a BATE election in order to take full advantage of the BATE, as a tiered partnership will claim a credit for the amount of tax by a pass-through entity, where the credit will not flow directly through to the tiered partnership's partners. So in effect, a partnership's owners would need to pay the tax in at each level, multiple levels, in order to secure the benefit while waiting to receive a refund. So, again, this is another issue in New Jersey and the way the mechanics of the BATE, their PTE. We're working with the state to see if we could work with them to put a legislative fix to this quirk, but it does require that each level pays and elects BATE, which again, you could require duplicated payments and so on. If we look at the next slide here, as Jonathan mentioned earlier, the BATE tracks the GIT rules in computing apportioned income. So what that means is that the BATE is going to use a three-factor equally weighted formula of sales, payroll, and property to be used to compute state source income, and then in determining the sales factor, it's going to use cost of performance sourcing. So what's unique about this is that, as Jonathan mentioned, S-corps in New Jersey typically use market-based sourcing, but when it computes the BATE for purposes of that election, it is going to use cost of performance sourcing. So it's super important when modeling out any BATE benefit, considering these sourcing rules, as that impact can have, impact on making a decision if you want to go forward with the election or not. So that's another quirk to take note of. If we look at the next slide real quickly, as we mentioned the due dates being March 15th, so the next election is going to be March 15th, 2022. If we look at the next slide, a lot of this stuff we've already covered, but We left in these additional details for anybody as a reference with estimated payments. So this is just here as reference. I'm not going to read through all of them just to conserve some time. If we look at the next slide here, same thing, right? We're here, you know, with the mechanics, right? Individuals are generally going to still require to file a non-resident return even if BATE is elected. So that's just something to kind of keep in note. And let's skip over to the next slide here. So we have combined filing implications. Again, these with the combined filing implications, these are special unique rules that are only going to apply based on, you know, specific facts and circumstances. And this is only going to apply when you have a corporate partner that's a member of a combined unitary group. So we're going to keep that in there as reference. And if we look at the next slide here, just to conserve some time real quickly, we also have some special rules on how S-corps might have special application with some unique facts and circumstances. So we're not going to go through all those details again. If you have unique facts and circumstances, it might pay to look at these special rules, but again, it's going to be limited to certain circumstances. So with that, just to conserve some time, let's go to polling question number 3.
Polling question number 3 is, would you consider making a pass-through entity election? Maybe your answer changed while we're going through the presentations. Maybe you're learning about it as we go.
We'll give it a few more seconds as the polls are still coming in. All right, going to go ahead and close this poll.
Perfect. So we have people that said there's no way they would do this. Maybe in some circumstances that is the case, but a lot of people are going to weigh the risk and rewards, which is proper treatment for this. Let's move on to New York. Jonathan, I think you're muted.
Thank you, Sally. Going right in, New York PTET. So this April, former Governor Cuomo enacted New York's PTET, and it's effective for tax years beginning on or after January 1/21. So the first year that PTE is effective is next year. The pass-through entities can elect to pay the New York income tax at the entity level, and the owners receive a credit on their personal returns for the entity level tax paid. And again, this saves the SALT deduction for owners of pass-through entities. Moving on to the next slide. So pass-through entities eligible for election generally include partnerships, LLCs, and New York S corporations. I will note that for an S corporation to make the PTE election in New York, the entity has to have also made a New York S election. New York is one of 2 states that I'm aware of that allow for S corporations to make disparate elections, where an entity can be an S corp for federal and a C corp for state. Well, in order to make the PTE election, it needs to be an S corp for both federal and state purposes. The annual election is generally due by March 15th, and we touched on this before, that by setting that due date, pass-through entities, the owners really need to count their chickens before they hatch, because that return is not going to get filed for another year after the election is made. And if you miss that due date, you can't elect into the pass-through entity tax, and of course that election is irrevocable. For the first year in 21, the election must be made by October 15th of this year. to elect PTE for 2021. For all subsequent tax years, it must be made by March 15th. And then there are specific rules on who needs to make that election as to who counts as an authorized person. So moving along to the next slide. So one of the big considerations is who is eligible to make a PTE election, looking at the composition of the owners of a pass-through entity. And in New York, the legislation does not disqualify a pass-through entity from making the election if they have partners who are also in turn entities. So a New York pass-through entity that has corporate partners, that has partners who are in turn other pass-through entities, are allowed to still continue to make the PTE election. But the only owners that will benefit from a PTE election are owners who are subject to Article 22, which is the personal income tax. We're moving along. So PTE taxable income is defined for partnership as all income from New York sources included in the taxable income of a non-resident partner, and all income included in taxable income of a resident partner. So the benefit to this is that New York is one of the few states that requires a partnership to file a New York partnership return just because there are New York resident partners. So the partnership itself doesn't need to have any item of New York source income. It doesn't even need to have nexus in New York. It's still obligated to file a partnership return in New York by virtue of having a New York resident partner. And because it's filing a partnership return, that entity is also entitled to make a PTE election. And on that PTE election, it would pay PTE on 100% of the share of resident partners, or 100% tax on the resident partner share, which means that even if that partnership doesn't have any New York source income, the residents can still benefit from saving that election. And in that case, when you only have, you're only filing because of resident partners, it really might be a no-brainer to file the PTE there because the non-resident owners won't have any PTE paid on their behalf. So there's no potential loss of credit in their home states, but it certainly does save the tax for the residents. And then for S Corps, all income derived from New York sources, again, for both resident and non-resident shareholders. So moving along. So again, New York provides a credit for taxes paid under the PTE regime. And for individuals, this credit is refundable for personal income tax. So that means that if an individual winds up overpaid as a result of the PTE regime, that's okay. They're going to get the money back. They don't have to worry about carry forwards. They don't have to worry about limitations. They just get a dollar for dollar credit for whatever is paid as a PTE. So that makes it nice and easy for residents and non-residents that they get a refundable credit. Moving along to the next slide. So New York, we can see that the tax rates in New York more or less line up with the personal income tax rates. That it is possible, again, for individuals with more modest levels of income to potentially be over withheld as a result of the PTE regime. But again, that's not a big concern because again, New York says you get a dollar for dollar refundable credit. So if you wind up being overpaid as a result of the PTE regime, that's really okay because you're going to get all your money back. That's not necessarily the case in every state, and we'll talk about that in just a second as we get to California. But again, the rates that you're paying on the PTE more or less line up with the rates that an individual would pay. Moving on. So again, that legislation, it appears that the allocation provisions track the partnership allocation formulas for electing partnerships. So again, partnerships in New York use cost performance rules, S Corps use market sourcing rules. We're still waiting on some guidance to confirm this, but in New York, it does not appear that there's a mismatch depending on the type of entity. The PTET tax paid at the entity level will match that entity's specific required apportionment. So again, S Corps are going to use their apportionment regime for computing PTE. Partnerships use their own regime for computing PTE. So the amount does track with what the individual would get. Moving on to the next slide. So the due dates, again, the PTE return, or the PTE election, typically due by March 15th for both calendar and fiscal year taxpayers. So fiscal year taxpayers have additional consideration as to when they need to make that election, because the due date for both calendar and fiscal year taxpayers is the same. So that means that a fiscal year taxpayer really may have to make a decision for when to elect very early in its taxable year. That a taxpayer with a February 28th year end might have to make the election for the next year on March 15th, 15 days into its new tax year. So again, it's something very important to keep track of. Estimated taxes, again, are required for calendar year taxpayers in 4 equal installments, so March, June, September, and December. But pass-through entity payments are not required to make estimated payments for 2021. The first year where estimated payments are required is 2022. Moving along. Other considerations, so trusts. So a trust, other than a trust is allowed a PTE credit on the trust personal income tax return, but it has to claim that credit. It can't pass along the credit to its beneficiaries. And then the trust also needs to be classified as a resident or non-resident trust based on the residency status of the trust and not the beneficiaries. So again, there is potential leakage there for trusts. And then with regards to non-residents getting a benefit from the PTE regime, you really do need significant state presence, because if the apportionment to New York for non-resident partners is very low, the PTE credit that they would get will in turn be very low, and it might not be worth making the election in a situation like that. So again, that's why modeling is so critical with all of these PTE taxes. Moving along. So again, New York, there is a quirk to New York in that duplicate estimated payments may be required. That New York, it's not really a glitch. It seems to be a feature that New York may be requiring both estimated payments by non-residents as well as PTE estimated payments, essentially allowing New York to get the float on those intentional overpayments. Now again, everything is refundable. There's a dollar for dollar credit regardless of the overpayment, and it is refundable. So everyone gets their overpayments back, but they do need to consider the cash flow implications as well as the time value of money. So again, entities making the PT elections in other states for purposes of resident credit, again, they can also claim a credit for entity level taxes paid to other states that are substantially similar to the New York PTET. So New York, they're saying, well, we're going to give, since we're giving credits for our residents and for people making the election here, we'll also give credits for residents making PT elections in other states. But there is some question as to what is a substantially similar PTET tax. And for S Corps, the resident credit is only available if the PTE is treated as a New York S Corp. I will say that some other states are not necessarily going to give a credit for New York. So like Pennsylvania might not give a credit for PTET paid by partnerships. And it would be interesting to see if New York gave a retaliatory denial of a credit on the other side. So again, those are all open questions. So moving on, I believe, to California. And we go to the next slide. So California, their initial year for making a PT election is, again, January 1, 2021. It is an elective PTE regime. It is irrevocable. Once you make the election, you are stuck with it for that year. Now, unlike New York, there are questions as to who is eligible to make the election. So both partnerships are S corporations that have exclusively corporate, individual, fiduciary, estate, or trust as partners are eligible. But if you have a PTE with partners that are partnerships and potentially disregarded entities, that entity may not be eligible to make the PTE election. If it has other partnerships as partners, it's clearly ineligible. We're still waiting on some guidance as to whether a DRE owner makes you ineligible. So again, there are also questions about publicly traded partnerships not eligible to make the election, and entities required to be included in California Combined Reporting Group or also makes the entire entity ineligible to elect the pass-through entity tax. Moving along. So the due dates. So again, for the first year The due date is the original return without regard to extensions. And then for subsequent years, it looks like June 15th, there needs to be payments made in of at least 50% of the elective tax paid to the prior year, or otherwise, if you're underpaid, you wind up being disqualified from making the PTE election. And moving on, I have to pick it up before I get the hook. The taxable base, so again, it's the resident owner's share of the PTE's income from net income from all sources, but non-qualified taxpayers, so again, corporate owners, they don't get any benefit. I will point out that the tax rate used for the PTE tax is 9.3%, which may be substantially higher than what an individual's liability is. So that in order to wind up in that 9.3% rate, someone who's married filing joint would need $600,000 worth of income. So for someone who has less than $600,000, they may be paying in substantially more than what their liability is. And again, California, while they give you 100% credit, they don't allow you to get a refund for it. You only get a 5-year carryover. So individuals who are being overpaid might wind up stranding credit behind if they're not able to utilize that credit within the 5 years. Moving along. That takes us to our last polling question.
Next question is, how much benefit do you anticipate you will recognize from making a pass-through entity tax election?
I'll give it a few more seconds as the polls are still coming in. All right, gonna go ahead and close the poll.
Perfect, a nice distribution with basically some leading to have to consider the benefit and cost. Let's move on to kind of the discussion of the states.
Yeah, if we as we wrap this up, as we go to the next slide, and maybe we'll take about 2 minutes, 3 minutes over today, for those who could stay with us for a couple extra minutes. Clearly, if we look at the jurisdictions that are mandatory versus elective, we can see the elective states overwhelmingly exceed mandatory states or jurisdictions for that matter. What's unique is, for example, Wisconsin did not enact a brand new tax. Rather, in that state, an electing PTE can instead elect to be treated as a C corporation solely for Wisconsin income tax purposes, and therefore be subject to a flat 7.9% anti-level tax. So you can see here, every state has unique features, unique issues. What we need to be making sure is, for example, with these elective states, right, can the PTE make the election based on the composition of the partners in the PTE? So like what Jonathan mentioned with California, right, certain partner types of the flow-through entity might result in ineligibility for the election. And we see that in other states as well, like in Minnesota, right? We see that a PTE owner can't be a partnership or an LLC or a corporation. So, again, every state has their own different unique features and different unique issues. One thing that, I don't know, Jonathan, you have 30 seconds in terms of your thoughts. What we've seen is that when it comes to the personal resident credit, the potential loss of a resident credit in one's home state, we've seen some tax planning, right? Such as possibly putting a special purpose entity at the top tier of a multi-tier structure, and you put all the residents of the electing entity. So for example, if we're going to make the beta election, you put all the New Jersey residents in one special purpose entity and make the election. What's your thoughts with that? Some planning around some of these issues to get the biggest bang for your buck.
Oh, there's absolutely planning opportunities out there if people are going to get denied. And I mean, we saw that in New Jersey. Again, where having a DRE might make you ineligible. Well, maybe you add an owner, maybe you add a spouse as an owner. Maybe you set up a secret, set up another entity to own 1% and become a regarded entity. Again, if you have people that are going to get denied credit, well, maybe you set up a special entity to just hold residents, and you can save the credit for them, save the deductibility for them, and not have adverse impacts on other taxpayers. There certainly is plenty of opportunity. Again, this is all new. Most of these PTE regimes have only been enacted within, in some cases, the last 60 days. So the way all of these things shake out is still very much a work in progress. So that's why modeling and planning is so critical with regards to these taxes.
Yeah, and as we look at the next slide here, with the tax rates, you can see, clearly New York and New Jersey, not all that surprising, lead the pack with the tax rates on the PTE, but that's not necessarily such a bad thing at the PTE side, because you are going to get benefit, you are going to get a larger SALT deduction, the more, the higher the tax is. One thing to keep in mind as we look at these tax rates is, some questions, Jonathan, we often see is the question, right? 2020-75 from the IRS, that notice that they put out in November, said that they would basically rubber stamp a SALT workaround. The question is, what's the difference between PTE tax versus a composite, right? Electing a file composite and taking the election that way.
Yeah, the big one is the deductibility. I mean, it's very clear that a composite election doesn't save the deduction for the owners. That a composite return is really just treating all of the non-resident owners as a single taxpayer and paying the tax at the owner level. So that doesn't preserve the deduction. So again, taxpayers that have traditionally been filing composite returns definitely should be looking at making PTE elections where available. I mean, they're used to paying the tax in at the entity level, but on the composite side, they don't preserve the deduction. On the PTE side, they do. In a way, I would almost say that to the extent that states enact PTE taxes, they're almost revoking their composite elections.
Yeah. Yeah, and as we look at the next slide here, which I find very interesting, is you can see it's almost a 50-50 split between the states that have an exclusion, right, where you pay at the PTE level and that income then no longer flows to the partners or shareholders, where other states for the owner offset use this credit mechanism, which the income still flows through, but you get a distributive share of credit to offset any double taxation at the state level. So it's interesting to see, and you can see some of these states, a lot of them are 100%. You can see a couple of them like Connecticut, right, that kind of skim a little bit off the credit to get a little bit bigger bang for their buck in putting out this PTE. So you still may get a good benefit with SALT deduction, but then you can see that certain states are skimming off from the top. And that being said, if we look at let's move on. I don't know, Zowdy, if there's any questions, but and if there are, we can always help address them after this webinar. I know we're a few minutes over. Let's go to the next slide. Zowdy, do you have any last second thoughts before we wrap this up?
No, just that we have a lot of great questions in chat that's coming through. I've been trying to address them as we go. A lot of them has to deal with kind of the difference that we said regarding, composite return versus this PTE. What are the differences, as well as kind of the electability and kind of the election features of each PTE. We are very happy to talk to anyone that has any additional questions, as each state, as we pointed out, has different treatments for these, and maybe whatever we gave in the response can be for a particular state and not the other states you're looking for. So we do invite you guys to have a conversation with us on these issues for more details.
Yeah, and real quickly, just a key takeaway from this is that states to target, right, with these PTE is going to be if you have a business with a large presence, significant presence in the state, it's got to be looked at. Or there's a lot of resident partners in the state that reside in the state, it should be looked at. Or just significant taxable income in any particular year, like Jonathan mentioned, maybe a transaction or something along those lines, it needs to be looked at. So As Jonathan mentioned earlier, with the New York PTET election quickly approaching, as it's due October 15th, really important to model these out, not only for New York, but for all states, and with particular attention also to the non-resident owners. And besides that issue, right, we spoke about the dual estimated payment regimes that are in place for some states. And we spoke about, right, maybe there's potential planning when it comes to, different strategies to maximize the benefit and minimize any loss of potential resident credits or anything along those lines. So at the end of the day, businesses need to holistically review its structure, sourcing, and operations to see if it makes sense to elect into a PTE tax. So with that, we thank everybody for joining us. If there's any additional questions, feel free to reach out to us. We're more than happy to help address them when it comes to your PTE tax election.
Thank you for attending our webinar. Please remember to take a moment to complete the online survey. Thank you and have a great day.